Hello, everybody, and thank you for joining us today. My name is Abby Hassa, and I will be your facilitator for today's webinar. We here at Compliant host these free webinars as a means to educate and connect the research community, and it is our privilege to do so. Our webinars are brought to you in partnership with Magi, an organization dedicated to streamlining clinical research by standardizing best practices for clinical operations, business, and regulatory compliance. In addition to offering free monthly webinars, Compliant has developed the first leading e-regulatory system designed specifically for clinical research sites. Compliant replaces cumbersome paper binders with a standards-based solution designed to centralize and automate regulatory documents and tasks to improve efficiency and compliance. To learn more about Compliant, please visit our website at compliant.com. Without further delay, I'd like to welcome our esteemed presenters for today's presentation. One moment. Okay. Anna Canty is the Senior Clinical Research Contracts and Compliance Analyst at PFS Clinical. Prior to joining PFS Clinical, Anna gained over 8 years of contracts administration experience in the traditional law firm and insurance brokerage settings, focusing on healthcare and IT industries. In her current role as a Senior Clinical Research and Compliance Analyst, Anna assists research institutions in the study startup process, negotiating complex contract provisions to align with site requirements and their unique levels of risk aversity. Her clinical research experience includes navigating sites through the challenging process of an investigator-sponsored research and government contract negotiations. She loves interpreting legalese, making legal concepts palatable for her clients. She has served on the board of directors for the Madison, Wisconsin chapter of NALS, the Association for Legal Professionals, since 2014, and has given numerous presentations and webinars for continuing legal education credit in Colorado and Wisconsin. And now, I will hand the presentation over to you, Anna. Anna, feel free to take it from here.
Great, thanks, Abby. I'd like to thank Compliant for the opportunity to present today. I'm hoping to take this really dry and boring topic on insurance and pique some interest for everyone. Before I get started, I want to remind everyone that none of this should be considered any kind of legal advice. And before you go out and change your insurance coverage, just make sure you're talking to your legal counsel, your risk management department, and your broker. So let's get started. This webinar will discuss the basics of sponsor-provided and study-specific coverage, as well as site liability coverage, the language provisions in a research contract that relate to sponsors and to sites, and how they can work together. We'll learn why we care about insurance in clinical trials, basic insurance terms and concepts, research contract insurance provisions, including a breakdown of the contract language, how to read a certificate of insurance, common insurance requirements, protective language, and some negotiation tactics. The difference between small and large sponsors and why it matters. And lastly, I'll point out a few trends I've noticed in recent contract negotiations. So, why do we care about insurance in clinical trials? There are all kinds of insurance laws and requirements that we need to comply with as employers, as businesses offering services, as medical professionals, even if we aren't engaged in clinical trials. So on top of that, engaging in research just adds another layer of risk to our daily operations. Where there is risk, there is a potential for claims. For example, a patient participating in a trial is injured by an investigational drug and sues the doctor that provided the drug. Once that claim is filed, any settlement or final judgment will most likely involve the payout of a sum of money on top of the cost of hiring attorneys for the defense process. This can all be very costly. So the goal of having insurance is to provide a safety net in the event of a lawsuit so that the individual or entity that is sued is not the one shouldering the entire cost on its own. This safety net protects assets if you have them, or will help you keep in business even if you don't have the assets sufficient to pay for a claim on its own. We mostly think of injuries when we think of the risks of participating in a clinical trial, but lawsuits can arise out of other risks associated like property damage, the use or disclosure of data, intellectual property infringement, data breaches, or noncompliance with laws, to name a few. So now let's go over a few basic insurance terms and concepts. The two primary types of insurance plans are fully insured and self-insured. These terms speak to the source of the funds available for a claim when an insurance policy is required to pay out on it. A fully insured plan is more traditional and means an entity pays premiums to an insurance company which are determined by the insurance company's risk pool, among some other factors. The insurance company is in charge of managing the funds and assumes the risk for paying all claims-related expenses. So this is different from a self-insured plan, which means the entity that is insured is actually the owner of the plan, and they pay the cost of the claim themselves. Instead of paying the premiums to an insurance company, on a basic level, they're basically paying premiums to themselves, building their own funding source for any claims. If there aren't any claims, the entity benefits then from saving the money that it would have paid out in premiums to an insurance company with a fully insured plan. Most self-insured plans have a saturation point where the entity can no longer pay for claims without risking its own assets. So this is where an insurance policy would kick in. It's usually called stop-loss coverage, and I won't get into that today. When we talk about insurance limits, we talk about the size of the pool of money available to pay for a single claim and how much is available to pay for all claims in total. These two limits are usually referred to as a per occurrence limit and an aggregate or annual aggregate limit. A per occurrence limit is often smaller than the annual aggregate. So if a per occurrence limit is, say, $1 million and the aggregate is $5 million, this means the plan could pay out as much as 5 $1 million claims in 1 year before claims would no longer be covered. And then they would reset the following plan year. AM Best rating and financial size categories. You'll often see requirements for insurance coverage to be through a company with a specific AM Best rating or a financial size category. AM Best is a credit rating organization that focuses specifically on insurance companies. By imposing a certain rating or financial size requirement in a contract, you're essentially getting some extra protections from an insurer's financial strength and creditworthiness. A newer, smaller insurance company might end up folding because it failed to underwrite premiums correctly and it isn't able to absorb the claims it has promised to pay. So requiring a more experienced, larger insurer mitigates some of this risk that you could be unknowingly taking on. Claims made for occurrence-based policies. These terms refer to the type of policies and the time frame limitation on claims. A claims-made policy will only cover a claim that is asserted during the policy term. An occurrence-based policy will cover a claim that is asserted at any time, so long as the incident or injury actually occurred during the term the policy was originally in effect. Going along with claims-made coverage is something called tail coverage. So tail coverage is additional insurance that can be purchased to cover claims asserted on a claims-made policy after the policy term. This is important when we think of side effects of investigational drugs that might not surface for months or even years after a study is conducted. Tail coverage can be purchased for a specific number of years after a policy expires, say 5 years, or they also can be purchased for an unlimited period of time, and premiums will be dictated by the length of coverage that you want. The length of tail should correspond to the risk level of the study, and we'll talk a little bit more about how to determine the risk level of the study and make sure that the insurance you have corresponds to that. Now we'll look at some specific kinds of policies that come into play for clinical trials. There's some commercial general liability, which both sites and sponsors likely have. This covers claims for injury or property damage arising out of their daily operations, whether engaged in clinical trials or not. Product liability would be coverage for the drug or device specific to a study. Typically, this is a policy carried by the manufacturer of the product, but in the context of clinical trials, product liability can be carried by other entities to protect from any risk they are assuming on behalf of another company's drug or device. Clinical trials insurance is a term that's used a lot when we're discussing contract language, and it could mean a couple of different things. It could refer to the medical malpractice insurance for the investigator, as many med-mal policies don't specifically include research. It could also refer to the sponsor's liability insurance, the lines of coverage covering the product and the protocol activities. Then we have something called umbrella coverage, which is coverage above and beyond a policy's claim limits to protect against major, large claims. For example, an entity with, say, a $1 million per occurrence and a $5 million annual aggregate policy might have an $8 million umbrella that would kick in if claims exceed the $5 million aggregate. Professional liability, medical practice, and errors and omissions insurance can be used interchangeably in many contexts. They all have the same objective: to keep a business in operation in the event a major mistake is made by someone offering services on behalf of the business. That mistake causes harm to a client, or in a clinical trial context, a study subject would be something that would be covered under one of these policies. If you are in a profession that provides advice to clients or provides a service, they can hold you responsible if something goes wrong, and that's what these insurance will cover. Indemnification insurance refers to contractual liability. When an entity in a contract is promising to indemnify the other party wants to be sure that the coverage in place will cover those obligations. An agreement in a contract to indemnify a party may be an exclusion on a commercial general liability policy. So the concept of indemnification insurance could refer to a separate line of coverage for contractual liability, or an actual circumstantial change to a policy, which would be called an endorsement, that would include these liabilities that someone is assuming under a contract. Exclusions to coverage may include liability assumed under oral or written contracts because an insurance company expressly does not want to pick up the cost of defending or indemnifying another party. Some policies may state something like, where required under contract, which is basically just saying that it could be different from policy to policy. On a side note, I wanted to bring up that breaches of an agreement can affect what an insurance company will cover. So if a sponsor breaches an agreement and they're agreeing to indemnify you, that could lead to a claim filed against the site, say if they're infringing on someone else's product involved in the protocol, their obligation to indemnify the site might not be covered by their insurance carrier because the claim came out of their breach. We also have cyber liability, which is coming more and more prominent. This generally covers your business's liability for a data breach involving personal information such as social security numbers, credit card numbers, account numbers, and personal health records. Data breaches are outside access to your electronic data, whether intentional or unintentional. I'll talk about this more towards the end of our presentation today. Finally, an insured or a named insured refers to the entity specifically covered by a policy. So an additional insured would be added to a policy in addition to the named insured. This is done via an endorsement or through the contract or written agreement between the parties. Your broker and legal counsel can help determine if another entity should be covered under your policy and how best to go about this. So, as we talk about research insurance provisions, a basic contract breakdown. Every insurance provision should include some combination or all of the following elements. You're going to be looking for the name of the entity holding the insurance, the type of insurance policy that they're bringing at play in the contract, the specific obligation the insurance is to cover. So if there's indemnification obligations or if someone's offering to pay for subject injuries, you want to see that they have the coverage specific for those obligations that they're agreeing to. You want to look at the limits. There's going to be, again, a per occurrence and an annual aggregate limit on the policies. You want to specify the duration of the coverage, and we'll talk more about why the duration is so important. And we'll talk about a notice requirement. So if there's any change in coverage, you want to know that the other party is going to provide you notice that their coverage is changing. And then also burden of proof. We want something in the contract that says that, you know, the parties are required to show their certificates of insurance or proof of insurance to the other party when requested. So how do we know what limits are appropriate to have? You need to first assess the risk involved in the study and the liability you are being asked to assume under the contract. You can assess the risk by determining who is agreeing to pay for the claim. Is this a drug or device study or just data collection? What study phase is this? Phase 1 studies are inherently more risky than most post-market studies. Best practice is to create buckets of risk levels and set your requirements for insurance levels for each bucket. For example, you can decide to require phase 2 device studies to always be insured with limits of $5 million per occurrence and $10 million annual aggregate as a business practice, and then only require for post-market and data collection studies a $2 million per occurrence or $4 million aggregate. Setting up these predetermined, pre-approved buckets will eliminate some of the need to independently assess the risk level for each study and save you time from unique approvals every time you're looking at a new contract. All you have to do then is check the protocol, identify the bucket the study falls into, and then plug those insurance limits into the contract. It's also important to know your own insurance limits and identify your level of risk aversity, which is different and unique for every business, depending on your size, the number of studies you're conducting, location, patient population, and type of study. Always consult your risk management department and your legal team to identify how much risk you are able to absorb and make sure that you're in compliance with whatever policies you do have in place. All right, so Abby's going to help us take a poll now.
Okay, I just launched the poll. The question is, do you request the opposing party's certificate of insurance prior to signing a research contract? I will give everyone just a few seconds to answer, and then I will read off the results. All right, just a few more seconds. Okay, I'm going to go ahead and close the poll now. And it looks like 41% of the audience said yes, 30% said no, and 29% are not sure.
All right, so it sounds like we're pretty evenly distributed there. And there are pros and cons for doing this. I'll talk a little bit more about some of the tactics you can use in negotiations, and one of those is requesting the certificate of insurance ahead of time. And there are reasons why that might be good for you to do so. So we'll start talking about what a COI is, because some of you might not have ever seen one. So we'll take a look at the format of a typical COI, which is on the screen. I know that, you know, this industry is very acronym heavy. You know, we're not any exception there, and COIs could refer to conflicts of interest as well. So in this context, in this presentation, anytime I say COI, I'm referring to an insurance certificate, which is basically a proof of insurance. So you're going to have the name of the broker that the policyholder uses, and that's usually the entity that's generating these proof of insurances. You're going to have a list of the entity that's covered by the insurance. You're going to have their contact information, and you're going to break down of the insurance companies that are providing the different coverages that are listed on the certificate. Under the type of insurance columns, you're going to see the different itemized insurance types. This is where you can see if a policy is claims made or occurrence-based, so that can be your trigger for figuring out if you need to request tail coverage. You'll see any product liability policies. So if there's a drug or device that's involved in the study, there should be a product liability policy. If there is not, that's one thing that should trigger you to ask for that, or find out which entity is going to be covering the study drug or the device. It also will show you the insurance limits per occurrence and annual aggregate. So if you're engaging in a phase 2 device study and you've already decided that you want a $5 million per occurrence and $10 million aggregate, and this insurance certificate says $1 million per occurrence and $2 million aggregate, you know that they don't have the insurance coverage that you require without approval to put in for this study. So that would require either a business decision on your part to break what you normally do and accept lower insurance levels, or it would require some negotiating with the sponsor or the holder of the policy to see if they can increase those limits for you. Oftentimes in the box at the very bottom of the screen there'll be a description of services or different coverages, and they'll list, the specific protocol number. They can list additional insureds. If there's other entities, if there's a CRO that's involved and they're covered on this policy, that information can be found there. So there's a lot of information that can be included on this certificate. I do know that if there is something that is included in your coverage that's not on this certificate, you should call your broker, because they can usually have these updated free of charge, and that's what you have them for. So definitely utilize them as a resource if you need something, your insurance certificate, to say something in addition to what it currently says. So why do we ask for a COI? We want proof of the insurance that the entities are bringing to the trial. We want to verify that the entity that's contracting with us is the entity that's insured. So if they're the ones that are agreeing to, if either entity is agreeing to indemnify in an insurance contract, we want to make sure that they're actually the policy holders and they're covered by a policy. We also want to see the COI, because if they're agreeing to certain insurance limits and their certificate has something different on there, they're only contractually obligated to maintain what they've agreed to in the contract. That means that whatever is different on their insurance certificate could change. And this is why it's so important to have the element of your language include a notice requirement if anything materially changes. Because if your certificate is different from what you've agreed to in the contract, that means that they could possibly change the coverage on you. And what else do we look for? We want to make sure that the policyholder's name is correct, especially with some small sponsors and some new sponsors. They might change their legal names. They might, things could change from the beginning of negotiations on a contract to the end. Protocols could change, insurances could change, and you just want to make sure that all that information is still accurate from when you first started or collected that certificate of insurance. You want to verify the types and limits are consistent with the contract. You want to look at the expiration dates, and this is a good place to trigger a business process for you. So policies are typically on an annual basis, and so if the policy expires in 1 year, you want to have some sort of a process in place to request the new insurance certificate the following year. You also want to look for gaps in coverage that the insured would be responsible for as a general ledger expense. And when I say general ledger, I mean for something that they're going to have to pay out of pocket, out of their own assets. These are things like deductibles or self-insured retention rates, which they're a defined dollar amount specific to a liability insurance policy that must be paid out by the insured before the insurance policy will respond to a loss. So they work like deductibles essentially. So, how much is the sponsor or the entity that's providing the insurance going to have to pay out front before their insurance kicks in? And then we also want to look for if the limits are shared or if they're site specific. So sometimes coverage is for a specific study, and then also for that specific site, or it's for a specific study for all sites. And so you might be sharing the aggregate amount with several other sites, and that's something to keep in mind. You'll often come across sponsors willing to accept a site's insurance terms if the site's willing to make their insurance terms mutual. So a small research-only site likely does not have the buying power for a policy with high dollar limits like a large pharmaceutical company does. So to approach these types of negotiations, you want to look at the risk being assumed. The sponsors assuming indemnification and subject to injury obligations under the contract, typically, the manufacturer is usually the sponsor as well, and they're also the entity that stands to commercially benefit from the research. So instead of agreeing to let the sponsor come down in insurance limits to match the site, it's fair to request that the sponsor impose limits that match the risk it's assuming and the benefit it stands to gain, which is disproportionate to the risk that the site is exposed to. When it comes to making sure a liability policy will cover all entities that the contract is assuming liability for, we come across an idea of agents or approved agents. The term agents can create a little bit of a gray area in contracting based on the interpretation of the term. This is because if an agent isn't specifically an officer or an employee of the party, there's a chance the insurance coverage won't include them in a claim. If a party is agreeing to indemnify another's agent, then they want to know exactly what agents those are so that they can have them endorsed onto the policy as an additional insured. They don't want to be put in a position where they're agreeing to indemnify agents of the site and then come to find out their policy doesn't cover those specific agents, and then they would be paying out of pocket for any claims relating with those agents. So sponsors requiring the agents be approved isn't necessarily them trying to police who the site uses, but it's them wanting to make sure they are covered under the insurance policy for the trial. And the best way to do that is by adding each individual to a policy so there's no gray area. Some sponsors don't have room for the gray area due to their size or their financial power, because some of them are very small, and so they're really worried about coverage and making sure that they're covered and they don't have to, shoulder any of the expenses of a claim on their own. Duration of coverage, what claims can arise after a study. You want to think about, the type of study that you have and what kind of exposures could arise after you've completed everything. All final payments have been made. Subjects have completed all the activities in the protocol. Injuries, data breaches can arise after the study ends, and claims can take a while to materialize. For example, results could be misused well after a study is terminated. Side effects could arise well after a study has been terminated. It depends on the type of study, and then also insurance is claims made or occurrence-based. So the duration and post-study obligations aren't as important for sites who, A, don't have study-specific coverage, and B, have coverage that applies to any future studies. So they're just always going to be covered. But as long as the site remains in business of conducting research, their coverage will be in place. But when a sponsor has study-specific coverage and claims may not arise until far after the study closes, that's where you want to make sure that you have some tail coverage in place for any claims-made policies. All right, so some of the protections that we like to build in to contracts to make sure that we're covered in case we don't know exactly what kind of insurance the other party needs to cover its obligations, or we're just unsure in general. We want to add something to the effect that the failure to obtain insurance does not limit the party's liability under the contract. And it's fair to ask both parties to do this, to agree to this. It's sort of a catch-all for anything that might not be expressly stated. So it puts the burden on each party to really investigate what kind of coverage they are required to have by law and what kind of coverage they might need to have to protect their assets. and that if for some reason they don't have a coverage that specifically addresses the claim that comes out of a study, that's not a way for them to say, sorry, we're not going to be responsible for this. Limits not less than, this gives the parties some flexibility in maintaining their insurance limits. So if you agree to a hard and fast, say $1 million per occurrence and $5 million aggregate insurance policy, you have to maintain that. And if anything changes or you decide to increase your limits or decrease your limits, you're going to have to notice and probably get permission from the opposing party to make those changes, since you've already contractually agreed to that. So if you agree to limits no less than, and then have your occurrence and aggregate amount listed, it gives you some more flexibility, because you can always go above and beyond that, and your coverage can change. It can, you can obtain more additional coverage without ever needing to notify the other party or request permission. And then speaking of coverage being changed, typically you'd want to know if someone's coverage changes, and it's usually if it's going to change, to the detriment of the other party. So using terms like materially or adversely in relation to the changed coverage and any notice requirement would be something that we recommend. So here's where I like to request the certificate up front rather than going back and forth. If we have the certificate up front, we know the cards that they're holding. We know what the policy is for the study. If it's study specific, it's probably not going to change. If it's a general policy, we might have some more flexibility there. If it's a policy specific to the site, there might be some more flexibility there. So we already know the cards they're holding, and we might be saving a lot of back and forth in the long run by reviewing the certificate up front. And it also lets us know if there needs to be a business decision. So if we set our buckets that we are going to agree to for this specific risk level of study, and we get the COI and we see that those insurance limits are much lower than the pre-approved buckets that we've already agreed to, we know that we either are going to have to see if there's any movement on the insured part to increase those limits, or we're going to have to bring this internally and make a business decision on whether or not we should move forward with the study. So I briefly touched on this, but yeah, implementing a business process for requesting these updated certificates annually and then auditing for compliance with the contract is really important, just to make sure that you're covered. Other ways that you can mitigate some of your risk and potential breaches. I see a lot of insurance provisions that say, obligate a party to have insurance coverage for any and all claims. And this is kind of a misnomer. There is no insurance policy that's going to cover anything and everything. There are always exclusions. There are always outliers that won't be covered under your policy. So, one of those would be if you breach a contract. That could be an exclusion to coverage. So, a claim could arise out of a breach of contract. So you don't want to agree that your insurance covers any and all. I'll show some examples here in a little bit, and you can see we usually build in some language that will say that you have sufficient insurance coverage for your obligations, just to kind of mitigate the possibility of breaching here. And then ensure you're insured. Ask to be named as an additional insured through an endorsement is one of the safest ways to make sure that your conduct of the study under a protocol is going to be covered by someone's policy. You can have the policyholder expressly agree to contractual liability insurance in the contract as well, as long as contractual liability is not an exclusion on their policy. This is fine. So no coverage will be perfect, but if you work with your legal team, risk management department, and insurance broker, you can mitigate unnecessary risk assumptions. So I have a few slide examples here of some insurance provisions that contain many of the elements that I've talked about and what you want to look for. These are just examples, and they might not meet your specific requirements or your risk aversion standards. So just make sure you always consult your legal team and your insurance people to ensure you're insured for the risks that you are assuming. I'm going to kind of breeze through these, but here's a mutual provision where both parties are agreeing to the same type of coverage. We have another mutual provision, a site-specific provision, which calls out a specific duration of coverage, specific limits, and allows some to be self-insured. You don't want to agree to having a fully insured policy if you're self-insured. So another way to not back yourself into a corner and allow for changes there. And sponsor-specific provisions are usually, when I draft them, they're a little bit wordier just because the sponsor usually takes on more of the risk of the study, and we want to be as clear and specific as we can. So let's talk about the size of a sponsor and why that matters. Risks can change depending on the size of the sponsor. So if you're a site and you are engaging in research with a large pharmaceutical company, they're going to have trials that are ongoing. They're going to have a large, funding source to cover more comprehensive coverage premiums, so they can afford higher limits. They can afford, more comprehensive coverage. Their asset pool is large enough that if coverage is insufficient, they can bear any additional costs against their general ledger. They have established business practices and products, which creates a certain longevity. They're going to be in business for a while. They're not going anywhere. They'll be conducting studies for a long period of time. Then we have, smaller sponsors and some newer sponsors. This could be their very first or their only clinical trial that they're conducting. Coverage could be limited to the premium they can afford. They might have, few assets. In the event coverage is insufficient, they wouldn't be able to shoulder anything that's not covered by insurance and might have to fold because of that. So you're looking at a company going out of business and not being able to pay out the claims that they've agreed to pay in the contract. So it's an additional risk on a site that wants to engage in a study with a smaller sponsor. So the best thing you can do here is do your research. If it's a sponsor you're not familiar with, you haven't worked with, you can always look them up on your state Secretary of State website and see how long they've been in business and look at their financial size and make some internal business decisions based on the type of sponsor that it is. Okay, now we'll talk about some trends in insurance. Cyber liability. The prevalence of the internet and data stored electronically means new types of exposures. Commercial general liability, which most of you will have, likely does not cover cyber liability. They are starting to exclude this from commercial general liability insurance because of the prominence of breaches or hacks where data is compromised. Even if the sponsor stores their ECRFs on a local server once they receive them from the site and aren't actually providing the cyber environment to the site, that server can still be hacked. The sheer cost of employing the legally required security measures in the event of a breach put a large number of affected businesses out of business each year. It's about 60% of businesses that get breached end up folding within 6 months, according to the National Cybersecurity Alliance. So a site may want to make sure that they don't have to financially shoulder the burden if the sponsor isn't insured for those legally required measures, since it would be very likely to fold if they do get compromised. I'll talk a little bit about phishing here because injuries aren't necessarily the biggest risk of a study anymore. there's a lot of big data, a lot of data being transferred back and forth between parties, and a lot of it incorporates protected health information, personally identifiable information, and so it's all about where this data is stored and how it is accessed, which can create some of these claims. You know, when you're getting fined per document that's been compromised, you know, the fines can exponentially increase. So phishing is one way that these documents get compromised. And according to Wikipedia, it's the attempt to obtain sensitive information, often for malicious reasons, by disguising as a trustworthy entity in an electronic communication. The word is a homophone of phishing due to the similarity of using a bait in an attempt to catch a victim. Here's a few statistics on phishing. The average cost for each lost or stolen record containing sensitive and confidential information increased from $201 to $217 in 2015, and I'm assuming that's much higher now. 71% of cyber attacks occur at businesses with fewer than 100 employees, so the smaller you are, the more vulnerable you are. More than 157 million phishing attempts are made daily, and more than 71 unwanted programs attempt installations or launches daily. So after they bypass security filters, 13% of all emails are considered spam. And then 30% of phishing messages are actually opened by the recipient. Of those 30%, 12% are clicking on the malicious link or attachment, which is essentially just letting the hacker right into your system. So the good news is that these breaches are preventable. They require action on someone's behalf, like you have to click on the link to allow them to install the malware on your computer. So no matter how tight-sealed your cybersecurity practices are, it doesn't protect you if the data is mishandled or stored under insufficient protections. Even if someone has a legal right to that information, it does not protect you from their misuse or disclosure. Training is really important in this area. Make sure you partner with your compliance director, your broker, and your IT provider, as they likely have some kind of a training program to help mitigate the risk of a breach. Some other trends I've seen in insurance, mutual insurance limits. I see some sponsors wanting to match limits with the site a lot more than I used to see. I kind of went over this already, but you just want to make sure that you point out that the risks are not necessarily even, and whichever party is bearing the more risk should have the higher limit, or just make sure that the limits that each party is agreeing to are representative of the risk that they're bearing. You know, it could be that maybe mutual limits are appropriate, but oftentimes one party is going to be getting more benefit out of a study than another, and so they should be bearing more of the risk. I've seen a few sponsors try to pass product liability onto the sites, and this might be because they're not the manufacturer of the actual product, but that's always an interesting conversation to have. You know, it doesn't make sense for a site to actually insure a product that they don't make and that they're using in accordance with someone else's protocol. So just a trend I've noticed, but I don't think that we've had any sites actually agree to that yet. And then limitation of liability. If you have certain limits or you have limited assets that could pay for a claim after an insurance policy kicks in, I often see sponsors try and put a limit on their liability. So they'll only pay out for claims up to a specific amount, and after that, they are contractually not obligated to pay for anything else. All right, and that is all that I have for today. I think we'll open this up for questions now.
Yep, thank you so much, Anna, for sharing your insights. At this time, we do want to encourage your participation. If you have any questions, please submit those through the questions pane on the right-hand side of your screen. We'll give just a few moments to allow people to answer or submit their questions. Save the date. Our next monthly webinar will be held on July 25th at 1 p.m. We will provide more details here shortly in a follow-up email. All right. And yes, for those, the slides will be made available. Let's see. One moment, please. Okay. We got a couple questions coming in. The first one is, Anna, for low-risk retrospective data-only studies, it appears that the usual insurance company clinical trial coverage tends to refer to, quote, FDA-approved trials or studies involving a drug or device. Cybersecurity teams tend to have lower limits and do not specify data research. It is not evident that retro data-only studies are covered at the levels needed. Have you heard of any insurance company language or riders that specifically, explicitly cover data-only studies?
So this is a great question, and yeah, this is where, you know, insurance policies vary from carrier to carrier. They all can be very different, and it might be that, you know, a cybersecurity, you know, provision in your insurance policy does not specify data research. And if this is the case, you know, you can add a rider for pretty much anything. It just has to go through underwriting, and you'll pay for it. But you know, you can add all kinds of things to your policy. So I would, in this case, I know that we've gotten very specific riders added to our policy for very specific lines of coverage with really, you know, different terms or unique to certain studies. This would be something where you would just want to work with the carrier and your broker to see, you know, if you can get something added to that policy. If it's not you that holds the coverage and it's the opposing party that holds the coverage, you could ask them to do that. And, you know, depending on what you're asking for, it could be cost prohibitive, you know, if underwriting comes back through. But again, that can vary carrier to carrier. So if one carrier is not able or unwilling to do it, or it's at a cost prohibitive premium, you can shop your coverage around and look at some other options.
Okay, thank you. Okay, next question. Should sites take a general stance to eliminate cross-identification?
So this is, you know, something that comes up very often in my discussions with my clients. You know, some sites don't have any kind of a contractual liability coverage in their insurance. And so if they're agreeing to indemnify a sponsor, you know, mutually, they're going to be shouldering the burden of that cost entirely on their own. And so they've made a decision not to do that. You know, now when it comes to things like negligence, you know, it does seem fair that a site would be responsible for its own negligence and the sponsor wouldn't be indemnifying them for the site's negligence. So, you know, there are lots of sponsors that have agreed to take the site's responsibility over an actual mutual indemnification provision. And I know that there are some template contracts out there that kind of, you know, work towards this elimination of the cross indemnification idea. So it is out there and it is common, and it really depends on your site and the sponsor situation, because I have had some sponsors not move on this, and then the site has to decide whether or not they're willing to take on that risk of indemnifying the sponsor should that situation arise.
Thank you. Next question. How does insurance coverage differ for federally funded studies?
Well, federally funded studies can be different. I have some experience with this, and this gets very nuanced. So actually, if you could contact me directly, I would love to talk to you about this in more depth, but I think it probably has a little bit, we don't really have enough time to go over something like that right now.
Totally understandable. We'll send that question to you directly. Okay, next question. What do you usually require for CROs or small nonprofits that help conduct trials?
This is a great question. CROs, it really depends. If they are the entity, the contracting entity, if they are actually a party to the agreement, we can usually get them to bring their own coverage into play. So we'll have an insurance provision just like we would for the sponsor pertaining to the CRO, saying the CRO will hold its own insurance. We usually agree to decreased limits for the CRO because it's not their product and they're not writing the protocol. They're really just involved in the administration. If the CRO is not a party to the contract, then and we know that there's one at play, we'll ask the sponsor to maintain coverage for the CRO's activities under the agreement as well, so that we know that they are specifically covered. Most sponsors already have their CROs added as an additional insured on their policy, or they have some sort of contract directly between them and the CRO, kind of dictating whose insurance coverage would come into play if a claim arises.
Okay, great. Let's see, we got a lot of questions coming in. I'm going to ask you a few questions, Anna. I know you mentioned if they are, you're not able to provide legal advice, so if these do that, feel free to just have them submit questions to you directly. The next question is, for MRCT multi-country trials, can one global policy suffice, or should each country be converted or be covered by a local policy from the sponsor's side?
That is a little bit out of my wheelhouse. I don't do a lot of international stuff.
Okay.
So I would talk to legal and your broker to see what kind of coverages might need to be in place then.
Okay. All right. What's an example of property damage that would need to be covered by a sponsor's insurance?
This is always a fun one to contemplate, and my team over here have had a really enjoyable time either learning of different scenarios that have arisen that have caused property damage, or just kind of coming up with our own. You could think of, say, some kind of a medical device that, spontaneously combusts in a supply cabinet, or, something like that. But there are some instances of property damage that could arise, or if a drug affects, I don't know. I don't know if I want to share all the crazy ones I've come up with, but.
Okay, no worries.
But actually, if you want to have the person that asked that question email me directly, I can send them some real life examples that we've actually had come up in some of our at some of our sites.
Great, thank you. Okay. Next question: for sponsor investigator clinical trials engaging international sites, when is additional umbrella insurance required? And I just realized it's an international question. We can.
I'm sorry. Can you repeat that one more time?
For sponsor investigator clinical trials engaging international sites, when is additional umbrella insurance required?
This is really it's a personal decision. Umbrella insurance is not necessarily a requirement. If it's sponsor-initiated insurance, if it's a sponsor, an investigator-initiated trial, and they're writing the protocol, they might have an idea of what the risks are and can work with their risk management team to determine, what kind of claims could come out in a worst-case scenario, and if a worst-case scenario claim is filed, what the dollar amount might be tagged on that claim, and if that dollar amount is higher than their insurance limits, then you'd want to look at the umbrella and see if the umbrella would cover that. but I think in that specific scenario, disregarding the international piece, it'd be up to the site to kind of require that you keep coverage at a certain level. And if you add a provision saying that that level can be covered by an umbrella policy, then you've met their obligation. But again, you kind of have to speculate what the total cost of a claim would be, which is really hard to do.
Mm-hmm. Okay, we're gonna just one more question here since we're running out of time. And if we didn't get to your question, feel free to email Anna directly. Last question: is it acceptable to waive subject injury cover or subject injury language for registry studies, assuming that cyber liability language is included?
So this is a great question. In a registry study, you usually don't have any kind of a subject injury factor. Your biggest risk there, you nailed it, is going to be the use and disclosure of the data. So cyber liability would be a great type of coverage to have. Whether or not it's acceptable is really a business decision. I don't know. I think that might be a deal breaker for a lot of sponsors to offer some kind of subject injury coverage when it's just a registry study. But most of our sites still want to review any absence of subject injury coverage and make an individual business decision on that. So.
Okay. Thank you again, Anna. That's all the questions that we have for today. If you want to send her any questions directly, email her. Thank you again to Anna and to PFS Clinical for sharing your knowledge and insights with us today. We really appreciate your time. This webinar is recorded. We will send you a link to the recording, and it will also be posted on our website at compliant.com. Thank you again for everyone that took the time out of your day to join us today. We hope to see you next month.